Hello and welcome to Aston University's coverage of COP26 as part of Aston Originals. You can follow us through COP26 at Aston Originals on Twitter. You can subscribe on YouTube as well. And to find out more university-wise about COP26, head online to aston.ac.uk/COP26. But today we are talking finance. It is the first proper day of discussion at COP26. So make sure you do go and check that out. But we have some financial experts with us today on the panel. We have Professor Andy Lymer and Dr. Ozlem Arikan.
Hello.
Hello to you both. Thanks for joining us. Let's start off with a little bit of a who's who. Start with you, Professor Lymer, and just tell us a little bit about yourself and your research.
Yeah, thanks, Sam. So I'm, as you just said, a professor at Aston University. My formal title is in tax and personal finance. So not unsurprisingly, my research area is looking at all aspects of tax and how people pay their taxes and why they pay their taxes, but also more generally at personal finance. How and why do people save, both for short-term and pensions and longer-term investments, and also looking at the way in which households make decisions about money and the things that encourage them towards good behaviours associated with their money, and those that sometimes constrain the ways in which they think about managing money as households. So that's the kind of stuff that I get involved in.
Perfect. Dr. Arikan?
Thanks, Andy. So my research is judgment and decision making of stakeholders both in financial reporting and sustainability related reporting. And my research particularly focuses on the style of information and how it impacts on decision making. So I'm trying to encourage investor companies and NGOs to make clearer disclosures about what they are doing financially and what they are doing in sustainability related issues.
Perfect. Well, thank you to you both for joining us today. And I mean, finance is a huge subject, and it's great that it's being discussed at COP26, and a whole day of events will be taking place. And I mean, one of them is pensions with impact, adopting a transitional mindset for a better future. Andy, you are the pensions man that we have here at Aston University. And what are the pros and cons when it comes to having a pension? Because I'm talking for myself here, and maybe lots of other people out there, is that you look at your pay slip and you go, thank God I've been paid, and then you put it in your pocket and then you forget about it. But you don't really look, well, I don't really look at those pensions contributions. But what are the pros and cons?
Well, you're in a lucky situation by the sounds of it, Sam, because you've got an employer that is making it easy for you to be able to contribute towards a pension. And quite a significant number of people in the UK, if you're an employer, if you're an employee, do have your employers doing that. We actually now all employers who have employees that are paid more than £10,000 a year are actually required by law to offer a scheme to all of their employees, and also to make contributions alongside the contributions that you will make as an employee. They're required to contribute at least 4% of your salary. So it's usually a good idea to engage a little with pensions. If you can afford to make a contribution as part of the offer that your employer is making to you, then it's usually a good idea, partly because your employer will then contribute another 4% of your salary. So it's free money for you. But also, actually, the government tries to encourage everybody to contribute towards pension schemes by giving you your tax back that you have paid on that contribution. So if you're paying tax at the average rate that most people in the UK pay tax at, 20% in every pound that you earn, then the government will give you that 20% back again. And if you earn more money and you pay tax at 40%, well, you get 40% of it back. And if you're lucky enough to be earning more than 150,000, they actually give you 45% back. So again, even more free money. Not only does your employer contribute money towards it, but so does the government to help you build your pension pot. So you get sums from three sources: what you pay, what your employer pays, and what the government contributes. So
and what's a con? What's a con, Andy? Is there a con? Is there any downside to pensions?
No, not really.
No.
I guess the downside is, and one of the key reasons why people don't contribute towards their pension, is because that money you can't access immediately. It's not a free savings account, or at least as the law is arranged in the UK at the moment, you have to leave your money in that pot until you are at least 55 years of age. So some of us who are close to that now, not so long to wait. But for younger people, when they're starting to think about all the costs that they have to establish themselves in their careers, sometimes looking at tying money up until they're 55 seems like a long way away. But it's a good idea to do so if you can, even if you can only contribute a small amount, because we have this thing called compound interest. Compound interest or compound growth means the longer you leave money invested, the more that money will grow, the quicker it will grow, because the growth that you get in the early years is continuing to grow in the later years. So you'll get growth on your growth, or interest on your interest. And so that can be your friend, because it can accelerate the speed with which things are growing. So I try to encourage people that I engage with to say, if you can afford to do so, as soon as you can, do put some money into a pension, because that money, not only you're getting free extras, as I explained earlier, but you're also getting this extra growth that you can't accumulate if you don't contribute until later. So, so there are a couple of good reasons to contribute to pensions.
This is a question maybe for both of you now, which is about choice and where our pension contributions go, and can we easily make our pensions greener? I mean, obviously, Ozlem, your background is largely in investments, and pensions are essentially investments, aren't they? So, I mean, do we have a say where our contributions go, and can we make them greener?
Andy, would you like to comment on that? It's about pensions regulations, I think.
I can do, yes. I think you're right, Sam. Yes, you absolutely can. There are various ways in which you can be active in engaging with pensions, and that, of course, is what the COP meeting is particularly about. Is trying to find better ways of encouraging people to be active in thinking about how their pension pots are invested. So we've talked about how you get your money in, but of course that growth is your pension, your managers, the people who manage the funds that you are creating, go and invest that money and put it into various investments on which a return is received, which helps your fund grow and pays them for the job that they're doing, of course. And so you can engage with them to some degree to try and encourage them to invest in things which are not only going to be not disadvantageous to environmental purposes and to producing money in ways that harms the planet, but actually trying to encourage them to invest positively, to put money in things which will actually improve the environment, which will head us towards zero carbon outcomes quicker. And if you're an employee, that sometimes isn't always straightforward. Most employees can access fund choices, so you can usually go and have a look at where your money is invested, and sometimes you have the choice to opt to invest in an ethical fund or a fund that is much more clearly directing itself towards objectives which are in keeping with the sorts of things that we're talking about here. And I will expect in the future to be more funds that will be towards encouraging positive impacts in the environment, to be more zero carbon, net zero focused. You can see more of that. So you have some control over that, although as an employee, often it's a little limited. Self-employed people have a little bit more control, because actually when you're not an employee, you haven't got an employer to do that for you. If you're self-employed, then you actually have to arrange your own pension through what they call self-invested pension schemes, where you can actually go and decide what pension you want yourself, rather than your employer deciding who your fund manager is. And then, therefore, of course, you have a lot more control over which funds you might want the money invested in. And providing you take into account the risk that you're taking, of course, you always need to bear in mind that any investment has a risk, and you need to think carefully about what risk you're willing to bear with your money. And your pensions are things you need to look after quite carefully for obvious reasons. But if you're investing for the long term, you can be active in thinking about how your funds are invested, and you can engage in doing that. And you can also do that. Those are direct ways. There's also indirect ways of doing things. So you can lobby your investment providers to think more directly about where their investment policies are and their plans and their objectives. You can write to your investment advisors. You can form part of investment clubs or groups that collectively with other people who you're also employees of your organization can involve, be engaged in being active. So you can indirectly influence the direction of travel as well as directly your own pots. So they're very
yeah. That's where a lot of people will say that having a planet in when you turn 55 to live on and spend some of your pension contributions and the money that you built up is one of the main things as well. But Dr. Ozlem, to look at some of the research findings about how companies tend to frame their sustainability efforts and how investors react to that framing. It comes down a lot of the time to the use of language, doesn't it?
Yes, it does. And Andy had made very good points about the choices investors have. And I would encourage investors to do their homework really well and look at actual reports the companies are producing about their sustainability efforts. So what a lot of companies seem to be doing right now is that paying just a lip service to these sustainability efforts, and they are typically very vague about their sustainability efforts. For example, they only vaguely talk about their future plans, but do not disclose anything in detail what they actually did in sustainability. They focus more on their core business, which potentially is not good for sustainability in their reports than the sustainability efforts per se. So I looked at one company's annual report, latest annual report, and it was a 104-page long annual report. And here are some sustainability related words the company used them. For example, they use the word sustainable only 6 times in their report, and they use the word environment 24 times, and low carbon just 16 times, whereas they use the word oil like 484 times, reserve like 388 times, which have a devastating impact on the environment. And it is true, Sam, that companies frame their disclosures in different ways. It is not about information, but it's the style of how they do it. For example, a recent research focused on apologies after environmental disasters. And what they find is really counterintuitive. What they find is that when companies put blame on somebody else rather than owning up their own mistake, it has a more positive impact on how they are valued by investors, which is very, very dangerous because then knowing this, companies could just put the blame on someone else rather than owning up their mistakes. So we need to educate investors about these things. And I think Andy also will have some words about investor education when it comes to pensions.
It's very, very interesting you say that, isn't it? Because I suppose it takes every big company, because I'm guessing it's mostly big companies that contribute to big environmental disasters rather than small SMEs. But it's going to take a collective effort, isn't it, to start taking ownership of these things rather than saying it's just business, because it's one of those sayings, isn't it? It's nothing personal. It's just business, and that seems to be the way that companies are looking at that. Would you agree?
Exactly.
And you mentioned education there, Ozlem. Let's go back to Andy and see what's being done when it comes to children's education, under 18s before you're reaching adulthood, and then we'll move on more into the investor education, which Ozlem will be able to shed some more light on. But Andy, if you can take the floor with what's being done in schools.
Well, financial education is now on the national curricula for second year secondary school age children. But there was a report done a few years ago by the all-party parliamentary group on financial education for young people, who found that actually in the 3 or 4 years since that became on the national curricula, the amount of financial education that was delivered through schools actually decreased rather than increased, which seems a little counterintuitive, but that's what they found. So putting it on the national curricula didn't actually increase the amount of financial education that children were having. And ironically, of course, they put it on the national curricula because it was already very low. And so we had a low figure that got even lower. And there are a number of reasons why that's the case. And we understand that the pressure that schools are under to deliver a whole range of things that are really important for young people to learn these days. And financial education has to take its place, of course, alongside so many other key life skills and practical skills and academic skills and capabilities that they need to learn. However, you won't be surprised to hear a big advocate that I think all young people need to have a minimum amount of financial education to understand things like pensions and understand some of the things that matter about how they manage and manipulate and arrange and organize and invest their money. That's quite difficult to deliver a long time in advance, of course, of when they may have enough money to actually do something with. Many young people don't have money to invest, of course, so they're learning principles that they can't apply. And so I think you're right, Sam, that we do need education going on throughout people's lives, both directed at particular things like investments and how to engage with pension investments and how to understand the information that accounts are presenting in the way that Ozlem is outlining, but also to ensure that people aren't frightened to engage with this.
That's a good point, actually, because I was going to say that it seems that almost, unless your parents are like hot on the heels or have that some sort of financial education themselves in terms of even opening a bank account for their children, that it maybe wouldn't happen. And we spoke before we started recording this about, it seems to be at the moment the approach is one of those things where you don't know anything about it until you need to know everything about it. And how do we get out of that situation by saying we need education, or is it more about putting a plan together and saying these are the most important things financially over your adult life? Anything else that you want to go and maybe search yourself is a bonus, but these are the main things.
I think that would be potentially a good approach, although how we operationalize that, how we make that work in practice is a challenge. And there's a part of government, the Money and Pension Service, that actually have the responsibility for, on behalf of the government, trying to upskill people in financial space. That I would really encourage anybody who wants any information at any point, any age, on that just-in-time basis. They need to make a mortgage choice, or they need to think about their pensions and whether they should engage with a pension or not. There's some great advice, fully impartial. I'm not trying to sell anything to you. Going and have a look at the Money and Pension Service website that lays out some of the core principles and things you need, and then points off to other bits of advice that will help you. Because I think you're right, Sam, that actually there is a real need for just-in-time information and the comfort that you are receiving information which is impartial and appropriate at the time you need it.
Awesome. Let's have a look at it from the other side, almost, of the debate, which is investor education. It seems that there is a little bit of a hole when it comes to that side of things. So we've got on the one side maybe a gap for essentially children, but what about the people that are making these key decisions?
Yeah, I mean, investor education is also key, and research finds that investors react to style of information rather than the content of the information. It is dangerous because it should be the content of the information and investors should be reacting, not how it is said. For example, when it comes to sustainability, there are two styles for companies to reflect their sustainability efforts. One is doing good. For example, you could say, I am improving my carbon emissions. The other is mitigating bad, where you say, I'm decreasing my carbon emissions. In both instances, you are exactly saying the same thing, only your style is different. But investors react to these two styles very differently, and in yet another counterintuitive way. When you frame it as doing good, investors react to more negatively. And when you frame it as mitigating bad, investors have a more positive reaction, because when you say you are mitigating bad, when you say I am decreasing the carbon emissions, investors perceive this as there is a problem and the company is dealing with it. Where in the other case, investors seem to be thinking that there is no problem, so they are not giving the credit to the company. And this is dangerous for investors, because they can make bad choices if they are going to be influenced by subtle differences in the language of the companies.
Perfect.
So we need some more education, teaching them their biases and how these biases may have a negative impact on their well-being, wealth, and investments.
And do you see that changing in the future? I mean, I imagine there's been quite a large cultural change in terms of investment as an industry, maybe over the last 50 or 60 years. Do you see it getting better, or do you think there is some sort of stumbling block?
I mean, there is a stumbling block, but in terms of sustainability disclosures, I think it will get better. Because the world is fully focused on sustainability now. So it's inevitable that investors will also learn about this stuff and will educate themselves more, yes.
Excellent. Let's finish off with maybe predictions, hopes for COP26. And Andy, start with you. Do you have any predictions?
I would like to think that the government continues the track that it is heading on towards bigger and bolder moves to try and increase the education of people, to try and provide clearer language, clearer opportunities for people to engage. This may need some regulation to help people have better access to the investment managers that they make. I think there's a role for the government to be helping bear some of the risk, I think, of some of these new businesses and these new ventures, because if you're going to be positively impacting the environment rather than just not doing harm, then actually there needs to be some new businesses coming into this space. There needs to be some sharing of that risk, because just relying on investors to understand those challenges and to put their money there is going to not be quick enough. It's not going to be substantial enough to make those changes. So having a government involved in thinking about where education is suitable, in thinking about when you deliver it and how you deliver it, particularly as, I mean, let's be honest, who wants to spend all of their time monitoring what their pension's doing? You know, we need.
I bet you do that. I bet you do exactly that.
I probably don't do enough of it as I should.
That's the weekend for you, isn't it? That's the weekend kicks in like the Flintstones when the buzzer goes off and he gets in his car and you go and look at your pension, don't you?
Well, but one of the things that makes that quite difficult, of course, is that many people have different jobs over their lives, and so they may develop pension pots in various different places, and in reality that can be quite difficult to keep track. And actually the government is doing something about this already. They've got a big scheme involved to try and bring what they call a pension dashboard together, so that you'll be able to log into one website and see all the pension pots.
Oh, so it'll suck all of them in that you've accumulated. So what would that be connected to your national insurance number or something?
Yeah. All the companies that are providing these pensions to you track you in various ways, and so the idea would be that it would all come into one location, so you can look and say, well, what pension opportunities do I have? And of course, that then links in to what we're talking about here, because you can say, no, hang on a second, I've got sums of money here that are invested in places that actually I wish to go and engage with and encourage them to invest in alternative ways towards this net zero goal that is so important. And everybody who does that is then making a contribution, and enough of us do that, it will make a significant change. So those are the kind of things I'm hoping will come out of this, some real practical things that enable each of us to make a difference in how we engage with this as an agenda. Very
nicely put. Ozlem, predictions?
Yes, I was a little bit pessimistic in my previous discussions, but there are a lot of good things happening as well. Companies are really putting a lot of effort in terms of their emission management. They are putting a lot of effort to reduce their carbon trace in the world, and investors really appreciate that. The less emission a company has, the more its market value is. And there are two strategies companies use. They can make operational changes, and a lot of companies are doing that, like they are using renewable energy for their own operations. But when this is not sufficient, they also purchase offsets. So they can assure that their net effect is zero carbon emissions. For example, Google does that. In addition to operational changes, it also invests in other countries for renewable projects. This doesn't have any impact on its own operations, but it reduces the overall impact. And investors seem to be appreciating changes in companies' own operations more. So I'm predicting that more and more companies will be focusing on their own operations in the future. And as investors become more and more informed about what companies are doing, what choices they are making, they are going to demand more clarity, more specificity. And I'm predicting that these will come in annual reports in the future.
Very interesting. Now, one last question for you both, and it is a yes or no. I'll start with you, Andy. Do you think COP26 will work?
Can I have? I really hope so.
Yeah, you can have one of those. Yeah, we'll let you. Ozlem?
I'll be optimistic and say yes.
Excellent. Perfect. Well, just a reminder that if you do want to go and check out some advice, moneyandpensionservice.org.uk is the one you need. Andy mentioned it earlier. And obviously go and check out the COP26 page at aston.ac.uk. Otherwise, follow us on Twitter for all latest updates. It's at Aston Originals. Make sure you subscribe on YouTube. And otherwise, we'll say goodbye to Andy Lymer.
Thanks very much.
Ozlem Arikan.
Thank you.
And it's a goodbye from me. Goodbye.